After the fallout we've seen from the essentially everything bubble ending in 2021, we've seen many media outlets and online personalities declaring that ESG investing is dead. But is that true? I would argue that we're not witnessing the death of ESG, at least not every part of it. We're witnessing its evolution. The fact of the matter is, the mania surrounding ESG itself was spawned out of an unsustainable market frenzy that we've gone through in the last 5 years or so. In its current form, the concept was destined for failure. What is the relevance between the E, S, and G in the acronym? Essentially nothing. Just that there was some vague concept of these three portions: environmental, social, and governance, all contributing to a better world. But besides that, the only tangible investable thesis here is on the environmental side. Yet it's obvious how we can invest in businesses that have a clear impact on the environment. Electric vehicle manufacturers, renewable energy, green technologies, the list goes on. They have a tangible impact on the planet, and there are various investment options in those industries. But how do we invest in the social side of ESG exactly? And what even determines if a company has a good ESG score? Because from what I'm seeing, if you buy into some of these ESG funds, you're essentially just buying the S&P index right now. They're dominated by the big tech companies. The social aspect of the acronym is incredibly subjective. Everyone has a different idea of what these businesses should do for their employees and the communities around them. And even worse, it can start bringing businesses into politics, which half of the population in the United States doesn't even support. So you're immediately turning people off. And the same thing goes for governance. How are you supposed to invest in good corporate governance? It's essentially a given to any company worth investing in, so there's no real tangible way to invest in this. That's why it's pretty clear that most of the ESG scoring methodology is probably centered around the environmental aspects anyway. That's the true differentiator from what companies were previously doing already. That's why Apple and Microsoft are stepping in and buying carbon offsets. That's why resource companies like BHP are selling off their oil and gas reserves. So I see the focus continually shifting away from these other portions of ESG, and the primary driving force that will remain is the environmental aspect. And why would that remain if people are starting to fight against ESG? Well, because we'll see trillions of dollars flow into environmentally friendly investments over the next few decades. Bloomberg was estimating that global ESG assets may hit a valuation of $53 trillion in total by 2025 alone, which would be a third of global assets under management. We'll need to see far more than that if we want to reach global climate goals, and you'll even see that in sectors that typically make for poor investments. Just in the copper industry alone, one of the crucial metals for the energy transition, we'll need $23 billion in new investment per year to build out new copper mines, according to Wood Mackenzie. The mining industry is one of the most destructive sectors of shareholder value, yet people will benefit from the massive demand that we'll see over the next few decades. We'll see that same trend occur in the automobile industry, electric vehicles. The current value of the EV market is around 200 to 300 billion, and regardless of what prediction's right, whether the industry reaches a market of 700 billion or 1.5 trillion by 2030, either way, the potential levels of growth here can get pretty insane. And these figures are in capital-intensive sectors that don't traditionally make for great investments. But someone's going to get wealthy either way. Now with that said, we've seen this area of the market get hit pretty hard over the last 2 years or so. Reuters has reported on ESG funds seeing the first annual outflows in a decade in 2022. Additionally, Morningstar has been talking about a sharp drop in new sustainability funds being launched, partially thanks to new regulations in Europe and the US about greenwashing. But the long-term growth drivers and overall sentiment remain. In contrast to those previous news items, PricewaterhouseCoopers held a survey in 2022 and found that 81% of institutional investors in the US had planned to increase their holdings in ESG-related products over the next few years, nearly on par with investors in Europe as well, at around 83%. So what's up with the conflicting results here? Like I mentioned earlier in the video, the market hysteria is over. The long-standing era of near-zero interest rates is over. Investors are sobering up and realizing that they want to see genuine results, whether that be profitability in the companies they dedicate their capital toward, or the ESG goals that many of these entities claim to support. We're seeing more regulations emerge across the world on this front, whether it be in the developed world or even emerging markets like China. Increased regulatory oversight will be the prevailing trend in environmental markets moving forward, and investing attitudes are evolving as well. Investing in low-quality, capital-intensive businesses that we've seen garner massive attention recently, only to collapse. Electric vehicle stocks are a prime example, and there's hydrogen, among other ESG ventures. This trend of mindlessly investing in hyped-up industries like that may very well be dead, although I doubt they won't make a comeback over time. But investing in quality companies with business models that have the potential to develop significant moats, great gross margins, that can also provide a net benefit to the planet at the same time, that's going to be an increasingly appetizing idea to many investors. Because the social pressures behind the rise of ESG investing in the first place still remain, and are possibly growing even stronger. On July 27, 2023, the UN Secretary General Antonio Guterres announced that the world has reached an era of global boiling. Climate alarmism is on the rise, as July was the hottest month ever in recorded history. And if you think social pressure on firms to make environmentally conscious decisions will decline, you have another thing coming. Over half of Americans think that climate change is a major threat. Nearly 2/3 of Americans think that large businesses and corporations are not doing enough to combat this threat. Now, we've seen how the numbers are actually even higher in other regions of the world. America is actually one of the more skeptical countries across the globe, especially the right wing. But regardless, this trend will be a persistent driver of climate policy at both a corporate and government level. These growing social pressures across the globe are being combined with an unprecedented level of financial incentives as well. There's been a rapid expansion of the green bond markets, where a company can potentially lower their cost of capital by complying with ESG-related debt covenants. And in addition to that growing market, we have a variety of tax incentives, grants, and subsidies from the government to make green investments increasingly attractive. And to top it all off, many corporations and governments have made pledges to reach carbon neutrality by specific dates. In many cases, there are milestones at 2030 or 2040, the ultimate goal to be net zero by 2050 across the world. So now many large companies have backed themselves into a corner, because if they don't start working toward their goals soon, the government's going to crack down on them for greenwashing, so there will be pressure on that front. There will likely be significant backlash from the public as well, at least the vocal environmentalists, NGOs, and so on. At this point, their hand is being forced. They'll have to continuously invest in green technologies, so it could be prudent to position ourselves in the sectors that have the most to gain. Now, ESG may take different forms over time. I assume that we'll separate out the E from ESG, but maybe that never happens. Who knows? What I do know is that we'll see trillions of dollars flow into green industries over the next several decades. The closer we get to 2030, where many intermediary climate goals are set, the more pressure will arise. Because of this trend, investment firms will be dying to buy in profitable, high-margin businesses that help the environment at the same time. Even if we only achieve a fraction of the investment goals that we'll need to hit to hold climate change at bay, there will be fortunes made in the process. But of course, this video is not financial advice, and I'm simply laying out my thoughts on what we'll see moving forward. So you may be asking, if we shouldn't buy into EV, hydrogen, or battery stocks, then what should we buy? Well, the primary way that I'm choosing to get exposure to this trend is through carbon offsets. A relatively new commodity that I cover often on this channel. I believe this space will be the greatest beneficiary of the battle against climate change. A sector that's only valued around $2 billion right now, while the voluntary carbon markets are projected to hit a valuation of at least $30 billion by 2030. So the sector is going to 15x. I don't know of any other space in the public markets with that type of upside potential. And this opportunity only exists because of how hated but necessary carbon offsets will be in the future. But if you'd like to hear more about that thesis behind carbon offsets, I'll link to a video on just that in the description below. Thanks for watching.